once you do these entries, you correctly align actual interest and coupon expense with the book value of interest expense. Make sure that when we talked about discount was debit, discounts on bonds paid. But once we reallocate value in the expenses, you must do what? You must credit bonds payable discount. So I repeat, we debited that way, but once we credit you did a premium, we credited the premium, but once you pay it, then you debit this bonds payable premium. And also, case of discount. So the value of discount is added to the coupon interest in order to indicate the increase in the cost of borrowing. And in the case of premium, the value of premium is subtracted from the coupon interest in order to indicate the decrease in the cost of borrowing. This entry and payment of interest, but you can call it an entry for accrual. In this case, instead of cash, you will create temporary liability until you actually pay the interest. And same here, instead of credit cash, you will have credit interest payable. But the entry and for accrual are of course temporary entry. Now we have aligned book value of interest and the coupon value of interest, but we equally must align the the discounted value of the bond or value of the bond with premium with the face value of the bond. So in other words, you need to prepare a special table where this value is gradually adjusted so that at the end of the life of the bond, at maturity, it is equal to the face value. You can clearly see that the opening balance of the bond was smaller than 12.5 million, meaning that the bond was sold at discount. This is discounted. And sometimes if you see that here the value is bigger than the face value of 12.5 million, for example 14 million, it means that the bond is sold at premium. Anyway, this opening balance must be adjusted so that it equals to face value at maturity. Of course, when you do the exercise, you may not get necessarily the same value. It will be something like 12,499,000 or 495,000. This is due to rounding problems. You will not be penalized for that as long as I see that the value here is something very similar to the face value, you get the full mark. So let's compare. So you will have one column that will have coupon interest rate. So in the coupon rate. So in other words, these interest payments are the coupon payments of 5,000. So this 5,000 here corresponds to 1.125 million here, this column for the coupon payment. However, this column would be calculated based on the market interest rate, and therefore it will correspond to the book value of expense, to this figure. And the difference between them, the reallocated bond discount, would be shown as the difference here, as the difference between these two columns. You can clearly see that 148,000 is difference between this and this, right? So when you do this table, it's called amortization table, you need to compare the coupon interest, the actual interest, with the book value of interest and compare them and find the difference. And then this difference must be either added or subtracted so that in the end you get face value. So in our case, what do we do here? It must be added. So that you add 11.5 million plus this difference, get bigger value. In the next year, you again add this difference and get even bigger value. And in the third year, you get this difference and add it here and get even